Let us start now because the students, they will be joining also. Okay, now. कौन है भाई? मोहम्मद यूनुस. The definition we have already discussed in the last class, and the two definitions which I have given to you, they were like this. In the first definition, the focus is mainly on the different processes, institutions, market, and instruments. So here, it is giving you this course will be talking about the process, the different institutions, the different markets, and the different instruments which are being sold in that particular market. So here, and it is a transfer of money that has been talked about. Now if you are going to see this, the small definition. See here, financial management is concerned with the maintenance and creation of economic value or wealth. Very important component of this definition is the economic value or wealth. It is concerned with the maintenance and creation. Now see, in case of the discussion of the scope of this subject, we have already considered that we will be concentrating on public limited company. We will be concentrating on the supplier of resources to the organization, mainly the financial resource. And in that case also, we will be more concerned about the owner of the business. And in case of company form of organization, whenever we say that the owner of business, our idea is that it is the equity shareholder. So the creation of economic value or wealth, they are in terms of the equity shareholders' value or wealth. So the scope of this course which we have limited, in that case also, further we are going to limit the scope of this particular course in terms of the welfare or the benefit or the different developments related with the equity shareholder. Now it should be clear to you that whatever decisions management is going to take related with finance, at all times they will have to consider how it is going to affect the shareholders' wealth. Now about this concept of shareholders' wealth, we will discuss in detail at later stage. But before that, I would like to discuss with you the 9-10 points. These points, they are in some books you will find that they have written them in the name of principles of finance. In some books you will find that some of these principles or some of these points they have considered as principles, but others they have not. So the background, whatever I am going to discuss with you, that should be clear. So that because this course, as we have discussed earlier also, that it is still in the stage of development. It is not completely matured course. So it will take some more time in getting these different terminologies standardized and to be used in different countries in the same manner. So still a standardization, that is a problem. In case of finance, it is not like our accounting system. So certain things, they are still in the developmental stage, and due to that, you will find that so many things, they are being considered by different writers, different authors in a different manner. So here, what point I am going to discuss with you, they are very important for the purpose of understanding finance. One thing more I would like to tell about these points, what I am going to discuss. To understand finance, these points, they should be understood. To understand finance, these are the different points, they should be understood. It is not that to understand these points you have to understand finance. It is not the other way around. That's why they are so basic, and their applications you will find at different stages during the course of your study. So you will have to take care about that, and the basic understanding I would like to be a bit faster in this case, so that the basic idea, they should be generated. And you should be familiar with these terminologies, you should be familiar with their applications, where you are going to use them. That is the important aspect which we have to consider. These points I am going to take up from here. The first, the 10 points for learning finance, the time value of money. The cornerstone of this particular course, that starts from here. This is a foundation stone. Without this, financial decisions, they cannot be taken. It is the time value of money which is the most important part, and it will be applicable at all the stages of your financial decisions, except in case of working capital, where the short-term decisions are there. So its impact we are not going to see in that particular manner. Now the question about this time value of money. Very simple description that has been given to you. 1 rupee of today is better than 1 rupee of tomorrow. You will say that, what is this? 1 rupee of today is also having 100 paisa, and 1 rupee of tomorrow will also be having 100 paisa. It is not going to change. But in finance we say that it is going to change. 1 rupee of today or $1 of today is better than $1 of tomorrow, or 1 monetary unit of today is better than 1 monetary unit of tomorrow. This is the concept which we will be using in finance at most of the stages. So you have to, what is this? Now you will ask this. See here, the most important thing is the value. It is not 100 paisa. It is same. Whether it is you are getting it today or you are giving it today, and or you are getting it tomorrow or you are getting it or you are giving it tomorrow. It is same 100 paisa. But in terms of value, 1 rupee of today is better as compared to 1 rupee of tomorrow. Why we say it? Because if you are getting 1 rupee today, it means you will be either using it for your consumption, present consumption, or you are going to save it for future consumption, or you are going to invest it. Then in that case, if you are going to consume, it is over, finished. You have got your satisfaction out of it, economics says that. If you are going to save it on your saving, you are going to get some amount of return in the form of interest. So if you are getting 100 rupees today and you are getting 100 rupees after a month, and you are going to save it in some bank, then this 100 rupees which you are getting today, that will be fetching some amount of interest on it as compared to 100 rupees whatever you will be getting after 1 month. That's why we say that early money is better money. We are also using it in a very simple manner. Early money is better money. We are going to take up it like this. Why? Because once you are getting this money, you have got the options. You can consume, you can save, you can invest. That is up to you, as per your own requirement, as per your own choice. You are having that. In that case, if suppose you are going to save, return will be there in the form of interest. If you are going to invest, there are chances you will be getting positive profit or negative profit. So I am using only this term profit with this prefix of profit, this positive or negative. So you will be getting a return in terms of profit, or you will be sustaining loss also. But here in this case, this 1 rupee that you have got this chance to invest it, and you will be getting the benefit of it. So this is very important. Now see about this particular time value of money. See, in our school days, generally in 5th and 6th classes, the teacher of mathematics, arithmetics you can say, they are teaching us about the compounding of interest, or the compound interest or simple interest, compounding of money. So we are very much familiar with that. If it is a simple interest, then in that case, every year, same amount will be added on your saving. If it is a simple interest, we know about that. If you are going to plot on x and y axis, it will be a straight line horizontally if you are going to consider. So this is the same amount every day, every year you are going to add to it. And we are very much familiar with that. Other option is that if your interest is going to generate some interest on it, then in that case, your amount is not going to be same, it is going to change, it is going to increase. What we call in this mathematical terminology, you are going to get your compound interest. So the compounding, you know, we are going to use this formula 1 plus r to the power n. We will be coming to that. I'm not going to discuss the mathematical side at this stage, but we know about it. 1 plus r to the power n, that will become the total amount, whatever you have invested in the next year, 1 year, 2 years, 3 years, 4 years, whatever is there. So compounding, we are very much familiar, and there is no problem in understanding that also. But when we say that, okay, the tomorrow money is value, if you are going to take it in a reverse manner, then what will it be? So 1 rupee of tomorrow will be having lesser value as compared to 1 rupee of today. 1 rupee of tomorrow will be having lesser value as compared to 1 rupee of today. Very clear. Then what will you do in this case? You are not going to do compounding. You will be discounting 1 rupee of tomorrow. Is it clear? In this case, you will be discounting the rupee of tomorrow, and you will be checking what is its value at a particular rate of discount, and you will be comparing with 1 rupee of today. If you are going to discount at a particular rate, and after discounting, if suppose you are getting after 3 years, then in that case your discounting will be for 3 years period, and then you will be checking that, okay, what is its value today, because you are going to compare with the 1 rupee of today. Then in that case, what will happen? You are discounting your future rupee for the purpose of knowing its value today. In the earlier case, compounding, what we have done? We have compounded our present rupee to know its value after a particular period of time. But in case of discounting, if you are knowing the value, or if you are knowing the amount of future period, what will be its value today? Because the future amounts, its value today will naturally be less if you are going to accept this time value of money concept. So in case of our investment, take for example, if you are investing few hundred rupees today, and you are going to get return over 5 years or 10 years period, you will not be getting all amount at one time. You will be getting this amount over a period of time. So what will happen? What will be the value of first year rupee? You are going to calculate. What will be the value of second year? Whatever you are getting, you will have to calculate. The 2-year discount you will have to make. What is the value of the third year amount which you are receiving? You will have to discount that, so that you will be in a position to compare what is the value of the amount, whatever you are getting from your investment over a period of time, and then you are going to compare whatever amount of investment you have made and whatever amount of return you are getting. And if you find that your return is more than, after discounting, your return is more than your investment, you will say that, okay, I am comfortable. and I will be going for this particular investment. I am not going to wait. So this time value of money, it is a very important concept in our financial decisions, and we are going to base most of the financial decisions on this. Take for example, long-term investment, which I have told you. You are going to purchase a machinery. The life of this machinery is 10 years or 15 years. So you will be expecting that this machine is going to give you return over 10 years or 15 years, whatever is the case. But every time it is not going to give you same return, because the market conditions, they are changing. Customers may be purchasing, customers may not be purchasing, because preferences, they have changed. Many factors are there in the market. So you have calculated, you have got the different indicators, and on the here screen पूरा नहीं आ रहा. Just please wait few minutes. देखो यहाँ फिर वही प्रॉब्लम आ रही. और फुल स्क्रीन होने का, और फुल स्क्रीन हो रहा है, देखने चेंज हो रहा है. हमारे यहाँ हो रहा है, वहाँ नहीं हो रहा. जब मैंने फुल स्क्रीन विंडो पे किया था इसको, लेकिन इसको जल्दी से करूँगा. इसको एडमिट करो बच्चों. हाँ, यहाँ एडमिट करो. इसको ये भी बड़ा मसला रहता है कि ये एडमिट होगा, पता चला ये आ गया. ठीक, चलो यही है. बात उसको करो ना. हाँ ठीक है. अब दोबारा फुल स्क्रीन तो रुक जाओ बस. आ रहा है भाई? It is changing or not?
Yes sir.
Yes sir.
Yes sir.
अभी कौन सा बताओ?
Sir, 10 points for learning finance.
अभी पेज बताओ यार कौन सा?
Same sir.
Sir, time value of money.
टाइम वैल्यू ऑफ मनी. चलो ठीक. अभी कौन सा है? पॉइंट 2.
अभी तक नहीं आया सर.
चलो अब फुल स्क्रीन हो जाएगा. अब उधर आ रहा होगा. प्रॉब्लम आ गई. ओके. So the time value of money, your investment at one time, return over a period of time. Naturally, we will have to calculate its value. You have purchased machinery 10 years, 15 years, and so you will have to calculate, you will have to predict, you will have to know what will be your return from this particular machinery over a period of time. And then after, you are going to evaluate in terms of your discounting of amount, whatever you are getting in future. And thereafter you will be comparing it. Then if you find that the result is coming positive, you will say that, okay, I will be going for this particular investment. So the time value of money, the most important factor, we will have to discuss in detail, and we will be calculating different rates for the annuity. We will be calculating for the different amount, we will be calculating at a different rate of interest, we will be calculating at a different discount rate. So compounding also we will have to consider, and discounting will also be considered. So there is complete set of understanding, calculations related with the time value of money, which we will do in the first unit itself, but at the later stage. This is just for the purpose of your basic understanding, so that when we are coming to this, you will be having some idea, some concept that what it is and how it will be used. I am giving you another example. Take for that, you have purchased share of Tata Steel, okay, and you have purchased the share for 2,000 rupees. All right, you are going to get return on that. Consider that one share you have purchased 2,000 rupees, you are getting 10% return on that. Then you will be getting 200 rupees on that. So, okay, you are considering it like that. After some time, you are okay. So every year you are going to get this amount. Now you will have to see that if I am going to keep this particular share for 5 years and I am getting, if the rate of return is same, then whether this amount that will be suitable for purchasing this share or not. We are going to do that. You have purchased the bond and it is 7% bond, okay, and this is a 15 years bond. So if suppose 1000 rupees share you have, this bond you have purchased and it is 7% bond, then in that case you will be getting 70 rupees per year, okay? And after 15th year, at the end of 15th year, you will also be getting 1000 rupees. Because this is the loan. So the loan will be repaid to you. And this maturity period is 15 years. So after 15 years, you will be getting 1000 rupees. And during this period of 15 years, you will be getting 7% discount, 7% rate of interest. So every year 7 rupees, 70 rupees, 70 rupees, 70 rupees you will be getting. But the 70 rupees of first year, when you are going to discount at a particular rate, the 70 rupees of second year, they will not be same. Because in one case you are going to discount it for 1 year, in other case you are going to discount it for 2 years. The third year 70 rupee, when you are going to discount it in terms of your present value, it will not be the same, it will be less than that. So when we are going to calculate it, we will have to see how much return we are getting and what is the value of that particular amount which I have invested, and the value of, and you will be getting 1000 rupees at the end of 15th year. So after 15 year, the amount you are getting, how much is its value? So you will be discounting it for the 15th year discount rate. And then after you will see that, okay, if I have 1000 rupees bond, you have purchased for 900 rupees, then you will be evaluating that, okay, I have paid 900, I am getting 1000 after 15 years. So it's discounting. When you are going to do that, is value that will have to be calculated. And every year 70 rupees, 70 rupees, 70 rupees is discounting, that will also be considered, because this is the return which you are getting on it. Whether it is the long-term asset or it is the financial asset on which you are going to get return over a period of time, we will have to see what is its position in terms of value, and then we will have to decide whether I should go for this particular investment or I should leave it as it is. So this time value of money, it is a very important concept, and without this concept of time value of money, our financial decisions, investment decisions, they will not be as what we are going to do in this particular course. So at every stage you will find that its application is there. Its application is very less in case of working capital management, because in case of working capital management, as we know, it is a very short-term investment. Material you are purchasing, okay, you are allowing the credit to your customers. It may be 45 days, it may be 30 days, 60 days, 90 days. So very shorter period of the difference between the inflow of money and the decision in terms of sale of the goods. So that part we will not find that much. Its application you will not find that much in case of the working capital. Otherwise, in case of your capital structure, where the sources of money are there, you will have to know what is the position of your preference share, equity share, retained earning, bonds and its value. So all the investments, whatever are going to be made in the company, the investor is going to calculate it in terms of return. So very important concept which I would like to tell you at this very stage. Calculations, applications, we will have to discuss that in detail at the later stage. So this should be clear. 1 rupee of today is better than 1 rupee of tomorrow. There is a difference of value of money. The value is not same. In terms of value, you are going to find that they are different. So this is going to affect our decision. Very important part. See here, oh, sorry. Oh, it is very close. It is not. Oh. Okay, cash is king, not the profit. See, we have seen in case of our accounting system, time to time I will be going back to the accounting system, but my scope in case of accounting, that will be limited. Our accounting system is based on accrual system, and you know about this accrual system. We have already discussed in the last class. In case of accrual system, what we do, whenever any transaction takes place, we are going to note them down in our book of account, irrespective of receiving cash or giving cash. This is our accrual system of accounting. we are going to consider that the cash has been realized at the time when the transaction has taken place. But actually that is not realized. Take for example, you have sold goods to your customer. You have sold goods to your customer on credit basis. Alright. If you have sold to the customer on credit basis, what will you create in your business? You will create debtor or creditor, any one of you?
Debtor.
You will create debtor. Always keep this in mind because sometimes you are confused. So this confusion should go. Debtor is always a customer. Always keep this in mind, very simple understanding. Debtor is always a customer. Don't be confused. Because in both the terms, credit is common. And creditor is always a supplier. Whether he is supplying you the goods, we will call them creditor. So the credit is a common element. In case of sale, credit is a common element in case of purchase. That's why you are sometimes confused that okay, whether it is a creditor or it is a debtor. No. Debtor is always is a customer. But he is a special type of customer. Why special? Because he has purchased goods to you, you have given him the goods, but he has not paid you. Then what will happen? Then you will have to run after him to collect money from him. So the cash will be coming in future. In this case, because he is on credit, he is a customer on credit. Very simple, and we call it the debtor. So the debtors are there. You have sold goods to the customer, but it is on credit sale, so he has not paid you. But in our book of account, what we are writing? We are writing sales. We are writing either, if you are writing in the terms of goods, then you will say that the goods they have gone out. And one who has purchased, you are going to debit that. And goods you are going to credit that. Or you are going to consider the sales, okay, you are going to credit that. So in this case, what happens? When you are going to sell goods on credit, the collection of cash that will take place in future. But you are writing this in your book of account as sale. So what happens in this case? Cash, so there will be the discrepancy in the calculation of availability of cash in the business and the total amount of profit, whatever you are going to consider. That's why they say in case of finance, the most important part is the inflow or outflow of cash. Always keep this in mind. Most of the things we are not going to write, whenever we are going to give the question or we are writing that, simply we will be writing cash inflow or cash outflow. So in case of this, it is not the sale only, it is the cash which is important. And it is not the profit that is going to be. So we don't say that profit is not required, or profit is not going to help us, or profit is not going to be the indicator for the purpose of taking decision. I don't say like that. But the predominant position is of cash. That's why we say that the cash is king, it is not the profit. So, and cash means that when they are using this particular sentence, when it is going to hit your hand, so that is the cash we are going to consider in this particular manner. So cash basis, we are going to consider that, okay, what is the position of cash we will have to calculate. That's why in case of accounting, in management accounting mainly, we have discussed about the calculation of cash flows, which will help you in understanding finance because you have already gone through that particular process. You understand what is this cash flow and how it is different, what additional calculations you are making from your profit and loss account and the balance sheet. Many things you are going to calculate based on that. Now see why this cash is important. There is a very simple reason which you are having in your mind, you know about that. Whenever we are calculating our profit, we start from sales. Alright. Sales may be credit sales, may be cash sale, but we are considering the both of them equal. We are writing total sale, irrespective of the cash position. We write that okay, the sale has to, because our system is not the cash-based system. It is an accrual system. So whatever is the position of cash or credit, it is sale, so sale will be written as sale. We have done that. After that, we have also considered the different type of expenses. Direct expenses, for example, we have reduced from here, and you could get the gross profit. Okay. From this gross profit, you have reduced the different type of marketing expenses, advertising expenses, salesperson's expenses, warehouses, many transportation, many things. You have then rent and taxes, many things you have considered. Okay. After that, you have calculated your profit. Profit is there, your calculation is fine, no problem in that case. But the finance people say that what is your position of cash? And see, in case of our calculation, there are certain items which we have treated as expense, but they are not the expense, as there is no outflow of cash. That's why we call them, they are the non-cash expenses. And the prominent example is of depreciation. In case of depreciation, what we do? We are charging depreciation on our long-term or the fixed assets. Okay. Why we are charging? Because we are accepting the matching concept. So due to that, the accountants, they are charging wear and tear and other things they will. But in case of accounting, it is a matching concept which is going to, which is leading for charging this depreciation. But this depreciation amount, whatever you are charging, it is going to reduce your profit. But the cash has not gone anywhere. It means there is a discrepancy in the calculation of profit and the availability of cash in your business. Due to that, what we do, we are calculating cash flow of business separately. Then what is the position of cash, how much it has gone, and where from it has come, where has it gone. We are changes in the working capital, the profit from operations. There are many things we are calculating in this case, and cash flow we are going to consider. In case of this finance, it is the cash which is important. So, and the adjustment of depreciation and many other, say for example, we are going to, many expenses we have made, the legal expenses and all, we are going to distribute over a period of time. And money has already been spent, but we are going to treat these expenses over a period of time. So in that case also, cash has not gone, but adjustments we are making. So there are many other expenses which we are considering. In short, it is the cash which is important. We don't say that the profit is not important, but the position of cash is supreme. We have to consider this. So this is the second point which we have to keep in mind. In case of long-term investment, you will find that we are using this cash inflow, cash outflow. Now, additional part related to this cash. Now see here, the third point says that it is incremental cash flow that counts. It is incremental cash flow that, it is only what changes that counts. Or simply I say that, okay, incremental cash flow, it is incremental cash flow that counts. Take for example, very simple example which we are finding in case of, and I am going to take help from marketing side. Suppose you are supplying one brand of your product in the market. Okay, the brand is already established, you are supplying them. Now you are going to introduce additional brand, any other brand. Okay, what will happen in that case? Some customers who have been purchasing the earlier brand, they will switch over, they will change. So what will happen in that case? When you are going to sell your new brand, some new customers will be coming, that is one point. Some existing customers who were purchasing your brand earlier, they will also be purchasing the second brand. What will happen to the first brand? In marketing terminology, we say that the first brand that has been cannibalized. It is a cannibalization of brand. When you are introducing from your company in the similar category, and there is a shift of customer from one side to the other side, that means the earlier brand that has been cannibalized. What will happen then? So the real amount of return on your second brand is not the same. Why? Because the additional, the brand, whatever used earlier, the customers who were using the brand first earlier, they have shifted. So the real return from the second brand is not the same. We will have to reduce from the second brand whatever shift that has taken place. That is the incremental cash flow. That is the incremental cash flow. It is not the total cash flow. You will say that, okay, second brand we have generated this much revenue. No. We will say that, no, you are not generating that. You have already cannibalized your existing brand. That means it is the incremental cash flow. By a particular investment, how much is your incremental cash flow, not the total. Keep this in mind. It is the incremental, because if you are going to consider the total, then what will happen? Then we will say that, okay, this is my investment, I am getting this return finished. But here we will say that no. This is the incremental cash flow that counts, it is not the total cash flow. So what will happen? We will have to make adjustment. We will be calculating how much is our return from this particular brand, but we will be making this this adjustment. If suppose this is your first brand, naturally there is no problem, because there is nothing like incremental. You have introduced this brand first, you have started your business. This is the first brand which you have introduced in the market. You have not cannibalized, you have not used your own customers in this. So those who have purchased your product, they are coming from some other company. So in that case, there is no incremental. But when you are having some brands which are already there, so the financial will say that, okay, it will be the incremental cash flow that counts. So first is, the cash is your king, but it is not the total cash, it is the incremental cash. Alright, now coming to the next point. Tax biases decision. See, in case of our decisions, it is not that, okay, we have invested money, we have paid interest on that, because the taxes will have to be paid. We are living in the tax economy. We are not going to ignore this. And tax rates, they are also not so 1%, 2% or 3%. It is not like that. They are quite good amount, 40%, 50% sometimes. So the taxes are there. So what will happen in that case? The taxes, they are going to reduce your inflow of cash. Why? Because you are paying tax to the government. So the tax will also bias your decision. It is not that, okay, I have sold these goods and I have got this much of return from there, and this is the incremental cash also. So I am happy. I am a successful businessman. We say that no. You will have to make your adjustment of taxes also. So what will happen in this case? Take these 3 points together. Is the cash inflow or cash outflow? Cash is the king. It is the incremental cash flow. So it is the incremental part you will have to consider. And this cash flow will be after taxes. This cash flow will be after taxes, because tax rate is very high, and at the same time you will have to pay to the government. There is no option left. You cannot say that, okay, I am not going to do that, because this is the obligation on the part of the business to pay taxes to the government. So the tax will be biasing your decision. So that is another important part which we have to consider. So whenever we are going to calculate our cash inflow, then what will happen? Considering these 3 points together, it is after tax incremental cash inflow that will have to be treated for the purpose of discounting, for calculation of your present value of future return. This is such a long caption, but simply we will be writing whenever we will be solving questions. At that time we are not going to write down such a long caption, that it is after tax incremental cash flow, that we will be writing, okay, cash inflow is this much. But we are having this understanding that it will be the after tax incremental cash flow on a particular project we are getting over a period of time. So this is the 4th point we have to keep in mind, and in case of our investment decision, we will have to take up. Now, very important part. See here. In finance, there is one term which is generally used. This is trade-off. We are using this. very simple terminology we are using for this term trade-off, that is balancing. Our teacher has taught us that trade-off means it is nothing but balancing. What are you going to balance? It is the balancing of risk and return. So it is a balancing, it is a trade-off of risk and return. Very important part of our financial decisions. Just like your this time value of money, this risk and return trade-off or risk and return relationship, sometimes we write it like that also. The risk and return relationship, that is another important component of our financial decision. Risk is, what is risk? See, finance people are having very simple idea about this risk. See, whenever you are investing some amount of money, you are expecting that it will be giving you some return. Look at this sentence. Whenever we are investing some amount of money, we are expecting that we will be getting some amount of return on that. Very simple, clear idea, no confusion. We are expecting. So we will be expecting for first year, second year, third year, fourth year, fifth year. We are going to expect. Finance people say that risk is the variability of expected return. Very simple idea about this risk. It is nothing but it is the variability of expected return. How much it is varying. So they will be calculating beta and so many things. That will be another important part of our study. But see this risk. Variability of your expected return. That is this. Okay. That is one definition. I am not saying that okay, this is the whole thing. But this idea you should keep in mind. Variability of expected return. See here, but here we are going to explain in a different manner. We won't take on additional risk unless we expect to be compensated with additional return. No one is going to take additional risk unless he is going to get additional return. So the risk-return relationship, this is one idea. The other idea related with this risk and return is that higher is the risk, higher will be the return, which is we are going to consider. Higher is the risk, higher should be the return. This is one idea. We are not going to take on additional risk unless we are expecting additional return. So this is another idea related to that. Variability of your expected return, that is the risk part of it. So in case of our financial decisions, this risk and return relationship, that is very important. And in finance, most of the time we are trying that there should be balance. There should be a trade-off between the two. There should be a balance between the two, the risk and return. Sometimes we find that we are expecting very high return from our investment. When you are going to expect very high return from your investment, or sometimes some organizations, they are also going to claim that okay, we will be giving you this much return over this period of time, and it is so high that you are fascinated. And what happens when the time comes? You find that they could not keep their promise. So due to this higher return, and you consider that okay, the risk is less, we will be expecting a good amount of return on that. So there should be a balance between the two. There should be a trade-off between the two. So risk and return relationship, that is very important component of our finance. So for understanding finance, this understanding that will always be there. Generally, you will find this risk and return relationship and its calculations in case of your share market, where you are going to calculate that you are going to purchase share of a company, and in 1 year, how much return the company will be giving you in terms of the market value, or it is going to give you what we call in case of capital appreciation, or the capital gain by selling that particular share in the market, how much you are going to get in the form of dividend from the market, you are going to take up that. So the risk and return relationship, that is very important, and we will have to see this mainly in case of our portfolio theory, which we will be discussed later, maybe in the specialized courses, but in the corporate finance or the basic finance, we will have to consider this aspect also up to some extent. Now I am coming to the, one point more. All risks are not equal. Okay, some risks can be diversified way and some cannot. So there are all the risks, they are not equal, because in some cases they can be there may be higher risk, in some cases there will be lower risk also. So the risks are not equal. Some risks, they can be diversified. Say for example, you are considering that I should not put all my amount in one company's share, because if suppose the company is going to wind up, or the company is not in good shape in 1 or 2 years period, there will be at loss. So what are you doing in this case? You are going to invest in so many companies. What are you doing? You have diversified your risk. In some, the risk rate is higher, in some, the risk rate is lesser. When the risk is higher, you are expecting higher return because the risk relationship is there. When the risk is less, you are considering that the return will also be less. So some risks, they can be diversified, but all risks, they cannot be diversified. All risks, they cannot be diversified. There are some risks which are equally applicable to all the companies which are operating in the economy. Government has changed the rule, so all the industries, the units which are operating in that, so they will be equally exposed to that. But in some company, you will find that, the risk may be more if the company could not produce goods and they do not supply in the market. So the return from the market, that is less. Many things, many factors. Some may be diversified, some may not be. So those risks which are equally applicable, you will not be in a position to diversify that. So all risks are not equal. Some can be diversified, some cannot be diversified. I think you are having the second period, 9:43. Thank you. Is all right?
Thank you, sir.
All of